My first group of questions is about LLCs versus S Corps. So the first thing is, what is the difference and when do you recommend setting up one versus the other?
So, well, first, thank you very much for having me today, and I'm glad to answer all of these questions. And again, as you said, there are going to be a couple of follow-up webinars that we are going to be able to go over any additional questions. But jumping into the LLC versus the S corp question, let's essentially discuss what these are. An LLC is a limited liability company that can be filed as a Schedule C or an S corp or a partnership or a C corp. And so an LLC, you're electing to file it one way versus the other. The difference on filing it as a Schedule C to an S Corp is the self-employment taxes that you're going to be paying. And so if the question is, when is it ideal to switch an LLC that files as a Schedule C to an LLC that files as an S Corp, it's when your profit and not your gross revenue now, your profit hits $30,000 per year or more. At that point, you are incentivized to change your filing from filing as a Schedule C, which is that return that you file as a part of your 1040, to filing an S Corp. You're going to reduce your tax liability by an estimated $4,000 if your profit margin is 30. And so the question should be, when should you switch? And the answer is when your profit is consistently $30,000 or more.
Um, just to dig into that deeper, when you're talking about your profit being $30,000 or more, does that include the income that you're making, or is that on top of that?
So when you're looking at a Schedule C or you're looking at a profit and loss on the Childcare software, what you're looking at is the gross revenue of your company minus all of your expenses. So that would be your food costs, your supplies, etc. What we're talking about is that net income. We are not adding to that net income additional income like your W-2 or your interest and dividends and other income. We're only looking at what's on your business income, which would be on a profit and loss or a Schedule C. And so when we're looking at is not the gross, we're looking at the net. So if you're grossing 50 and you're netting above 30, at that point, you should consider switching to an S corp.
When is the best time of the year to create an LLC? Would I need to file as an LLC for the entire year if I file now?
So now let's think about what an LLC again is. An LLC is a limited liability that you're registering with the state. It allows you to limit your liability as a company and not put it all on your person. And so if we're thinking about the cost of creating an LLC, we're talking about the Secretary of State that you're paying in the state that you're in. Once you create that entity, you're filing that entity for that year. And so, for example, if you started in the beginning of the year as an LLC, you're going to file it on your Schedule C or your S Corp as an LLC. If you're a sole proprietorship, you're filing it for the entire year on that same Schedule C. So essentially, the entity doesn't change. It's just whether or not you have limited liability protection under an LLC. And so when is the best time to file it? It's when you start the company. You want to limit your liability as soon as possible. It does not change your tax situation unless you convert it to an S Corp. Your tax situation stays the same if you're filing a Schedule C, whether you are a sole prop or you're filing it under an LLC. What changes is your liability protection. And with the industry that we're in, with kids hitting each other, or God forbid, kids falling, limiting your liability should be a key as a business owner.
So if I don't have an LLC, I've been doing this for years, you're saying set it up as soon as possible just to cover yourself and your assets.
As soon as possible. And it's the cheapest insurance policy you can get. So let's just hypothetically say we were discussing this at the end of the year last year, and you were considering whether or not you should wait until this year. All you're essentially saving is that additional fee you would have paid last year versus this year. But having that protection could be a lot more valuable to you than that 50, 100, $200 that you would have paid to the state. It's the cheapest insurance policy out there to protect you and your business. And so definitely set it up as soon as possible if you're not able to set it up from the beginning. Now, if you don't have it and you decide not to have it, what you're essentially wishing is that your business never is challenged, or you're never sued, or a kid never falls. And that's not really a good way to run a business, because it could be a situation that happens that you have unlimited liability. At that point, you're bankrupt.
Yeah, I think that's a really interesting thing that you just said because I know a lot of childcare providers sometimes struggle to think the difference between owning a business and being a caretaker. And this is sort of one of those steps that you can take as a business owner that is not going to go against being a childcare provider, being a caretaker, but is going to protect you in case something bad happens.
Exactly. It doesn't change your tax liability unless, again, you convert to an S Corp. But from a limiting of a liability, separating the income, from all of those standpoints, it makes a lot of sense to set up an entity as soon as possible, if not from the beginning of your business.
Awesome. All right, last question in this section. I guess you sort of covered this of how much it costs to set up an LLC. So can you talk more about, so it's just whatever it is per state?
So you have some states, like say the state of Georgia, that's $100 to set up, where in California it's $800 to set up. Depending on your state, it's whatever the Secretary of State is charging, and that is an annual fee that you're paying. And so your setup cost is going to be the LLC formation, your annual fee, and if you have a registered agent, which for some of you might make sense, for some of you it might not, it's an additional fee on top of that. And so looking at your budget, it might make more sense for you to be your own registered agent as opposed to hiring that out. But you're going to pay whatever that state fee is in the state that you're located. And for the most part, that is an expense that you can write off as a business. And it's an expense that you're also looking at annually as a way for you to be able to say, what do I need to charge my parents to be able to absorb this additional fee? So if you're in the state of Georgia and you're paying $50, maybe that's not an increase annually for your parents. If you're in California and you're paying $800, you might need to do an increase on your parents in order to absorb that additional fee. That should not be an excuse for you to say, no, I can't afford to pay it. If you're in business, you're either going to pay it now or you're going to pay it later. It makes more sense to cash flow plan and pay for it when you need it, because it limits your liability as you proceed in your business life.
That's awesome. Thank you. What are the most common mistakes that home childcare providers tend to make with taxes?
The number one mistake that I've normally seen, and it's not really a mistake, it's more of a, I guess it's just not a being accustomed to being a business owner, is keeping your books regularly. What I see a lot in practice is folks getting their returns ready just in time, or their books ready just in time for returns. And your bookkeeping should be something that you do on a regular basis, just like you are with the cleaning, or you might be able to maintain the house, or your advertising are done regularly. Your bookkeeping should be a function that you kind of do either daily, weekly, at most monthly, but it's something that you should do regularly as a business owner and not once a year when your returns are due. And the reason why is because what you're wanting to do is capture the expenses as you go. You're going to forget a lot of expenses, maybe miles, out-of-pocket expenses as you're going. And so when you look at it a year later, you're not going to remember what you spent in January of 24 or March or April of 24. But when your return is due, all of the income is recorded, not all the expenses are there, and now you're overpaying in taxes. And what I've seen a lot of folks do is they try to underreport their income or estimate taxes, which then gets you in a whole heck of a lot of issues with the IRS and the state. You're better off doing your books as you go, which is going to minimize your tax liability. It's going to put you in a better position cash flow wise, and it'll relieve a lot of stress in your life where you don't have April 15th, looming around the corner. You're kind of ready for it. You know what that liability is going to be by the time it gets there, and you budgeted it into your books.
Yeah, that makes a lot of sense. One thing that is not one of the questions I was going to ask because we're going to go into a whole lot in our next webinar. But so many people were asking about time-space calculations. And I know Parachute, we have the ability to have expenses, have time-space calculations. But one thing about doing your expenses, your bookkeeping regularly, is you also can keep track of those hours, which is going to be really impactful for your time space as well.
100%. The one thing that you're going to remember with the time space that's really key is yes, you're keeping the hours that you're running your center. And so if you're open from 6 to 5, 7 to 8, you have those additional hours when you're doing your webinars that you might not be catching, those additional hours where parents are dropping off their kids early or leaving them late, or weekend sessions that you might have where you're providing additional services. Those are hours that you need to capture that are going to increase that write-off for you when it comes to time space. And again, just like you pointed out, the Parachute software is one of only two softwares that I'm aware of that has that calculation where you're able to keep track of that. You're also able to split supplies, home office expenses, things that you're able to split on the time space that are not necessarily 100% for the business that you might be losing if you're using, say, a QuickBooks, where if you're using Parachute, you might be able to use the time space and you accurately keep track of that as you go.
For sure. And not only being able to split the expenses, but also being able to individually put in the hours that and the activities that you're doing in order to add to that time as well.
Yes, outside of your normal operating hours, you're able to add each activity as you go. That is correct.
For sure. Awesome. So let's talk about spouses. So is it better to file jointly with your spouse if the provider is an LLC and your spouse has a job that is a non-self-employed job, so they're working somewhere else? How do you deal with that?
So normally I would deal with that in either a tax planning session or during the tax prep, where you would do a joint return where all the income is accounted for, and you would do what is called a married filing separate template split off to be able to see as a family, are you better off filing separate versus joint? And normally on a case by case basis, depending on the number of kids, depending on whether assets, it might make sense to file one way versus the other. But this isn't really going to be something that we can automatically answer one way or the other. It would depend on your specific income, what brackets you're in, what liabilities you might have, if there are refunds due and one spouse owes versus the other. And so it's a case by case basis. But I would say when you're filing your return, it would be a good idea to do a married filing separate comparison to see as a family, would you be better off? And normally I would see that being a calculation that makes sense at a higher income rate. So if your AGI is above 150,000, it might make more sense for one spouse to pay their taxes and for the other spouse to pay or receive a refund on their end. But normally when you're below that, it most almost makes sense to kind of have a joint return. But again, this is a case by case basis and it would depend on your specific criteria.
And remind us what AGI stands for again.
Oh, adjusted gross income. That's the number that you look at and see on the 1040. It's normally line 20 or 15 on the 1040 side, depending on what year return you're looking at. They've changed these 1040s so often that the number changes, but adjusted gross income is the number that we use for both a tax filing. You also use that number for borrowing on a house and bank loans and all of that. Is the AGI is normally the number that's used.
Do tax benefits still apply to me if I am unlicensed?
As long as you are in a state that allows you to operate without a license, then you're able to get all of the tax write-offs and credits as the person that is licensed in a state that requires a license. And so licensed and unlicensed wouldn't impact your tax liability as long as you're operating in a state that allows you to operate without a license.
Otherwise, you probably need to talk to somebody about your situation.
Definitely, yeah, because it might be a legal situation at that point.
Okay, awesome. What are some of the most common expenses childcare providers forget to deduct from their taxes? I know you mentioned earlier the LLC fee. I know software, credit card transaction fees for tuition. What else?
Mileage is one that I often see that's missing. Office expenses like your pen, papers, printer, ink are expenses that I normally see that's missing. Sometimes I see license fees that are missing, which should be a thing that is automatic as a provider because that is something that you're going to have to pay for. And then also, I would say your meals. If you have business meals, so remember now the rule, if you are in a conference that you're essentially paying for, or you have a business meeting over, say coffee. So there's a business purpose to these meetings. You're able to deduct these business meals as long as there's the business purpose for them. And so I've seen a lot of those kind of thrown to the side or travel, business travel that's not included. Being able to be mindful and going back to that original, statement of saying, making sure that you keep your books and records on a regular basis allows you to keep track of these expenses. But mileage is one that's big, supplies, office expenses, meals. These are expenses that I normally see that are missing. And then the 8829 is something that I would see as a hit or miss. And so that's the time space. Some accountants will say don't use that because you don't need it, which doesn't make sense if you're reporting all of your income. If you're reporting all of the income that you're generating, you need every write-off. If you don't need that write-off, that means A, you're not producing a profit, which you might need to look at the business structure, or you're not reporting all of your income.
You brought up something interesting. So if I go to my accountant and I have my time space, I have everything, and they say you don't need time space, how would you deal with that?
So you always review your return as even if it was professionally prepared, you would review that return with the professional that's preparing it to make sure that you understand what is being done in your name. At the end of the day, these returns are being prepared for you. And as preparers, yes, we do have legal responsibility, but the ultimate responsibility falls on you as the business owner and the person signing off on the return. So if it doesn't make sense to you, ask questions. Make sure that all of your income is being reported. And if the 8829 is not being included, there might be a legitimate reason for it. I'm not saying that there isn't, but you have to understand why it's not being included and does it make sense? Because if it made sense on your kid care software that it was included and you still had a profit, but now you don't need it and you're not showing a profit, something got lost in the conversion. When the report was taken from your accounting software over to your tax return, if the numbers don't match, something is missing and further clarifications need to be made, or else you shouldn't file that return because you don't trust that it's being prepared accurately. And again, at the end of the day, you're responsible, even though you are paying somebody to do it for you, you hold ultimate responsibility, anything that's being done in your name.
So then if I look at all of my tax reports and I feel comfortable about my profit from my profit and loss statement or my Schedule C, and then my tax preparer is telling me something else, that's when I should start asking questions.
That's when you should start asking questions and maybe at that point considering finding another preparer, because if it doesn't make sense to you, it will not make sense to an IRS agent. And so as the business owner, you have day-to-day activities with this business. Whereas the preparer, I might see it for a couple of hours a year where I'm essentially reviewing the books and filing the return. If it doesn't make sense to you, it will not make sense to an IRS agent, which means it's being done incorrectly.
I think that's a good reminder. You're your own business owner. You should feel confident about what you've put together.
100%.
How do I easily calculate time space percentage? That is something that I can help answer, which is Parachute. So within Parachute, you can enter in all of your expenses, you can choose time space, and then you can enter in the amount of space of your home. You can enter in all of the hours including time that you're using to watch a video or going to webinars, all of that. And then that will end up in your Schedule C and your 8829. And we will talk more about that and show that in our next webinar. I don't know if you have more you want to add to that.
Yeah, so I mean, Parachute's really one of two softwares that I know of that has that. And so if you're manually trying to calculate your time space, it's possible, but it's really, really hard and it's time consuming. And automation is key. What you're wanting to do as a business owner is use tools that are available to you. And using the Parachute software is really a key that is going to allow you to maximize that write-off and make sure that you have, an appropriate write-off that you can justify to an IRS agent if that ever happens.
Are there tax differences when dealing with family members versus employees? So if you are having a family member come and work with you, do you treat that differently than if you have, somebody that you're hiring, somebody outside of the family who's helping out?
So if you're hiring an employee to do a task for you as a business owner, whether that person's a family member or a person that you're bringing in as an employee or a contractor, no, it doesn't change the nature. If they're W-2 employees, you pay them as such. If they're contractors, you pay them as such. What I see normally in practice is if they're family members, you're paying them cash, which essentially means you're putting the tax responsibility on the family member, which then puts it back on you because it's your business. And so when you're dealing with family, you have to deal with them in a way that minimizes your liability, and paying them the right way from the beginning makes more sense than to pay them as a contractor, eventually putting a tax responsibility on them, which might sour that relationship that you have with them. But as a business owner hiring an employee, treating that employee as an employee, it doesn't change whether that person's a family member or an outside individual.
And is there a cost threshold on that? Like if somebody comes over to do one day of something, should they be W-2 employee automatically, or, is there sort of like a little bit of wiggle room there?
So if the job that you're doing requires them to be there at a certain time, requires them to do a certain job in a way that you're instructing them to do it, that person is a W-2 employee. And if they're there for a day or 2 or 10 days, you pay them as such. If they are a plumber that comes in and does a job, and all you're essentially saying to them is fix it, however long that takes you, whatever tools you're using, that's your business. That person is a contractor. Most of the time, the people that you're hiring are going to be employees, and you're going to want to capture them as employees on your books and also pay the payroll taxes that go with them, whether they're there for a day, 2, 10 days, or a year.
How do I claim meal costs as a deduction if reimbursed by the food program?
So reimbursements are included into your profit and loss or your Schedule C as income. And so all of the reimbursements that you're getting, you're essentially including as income. Therefore, you have to exclude the money that you're paying as an expense. And so all the money that you're receiving, you're going to receive either on a monthly, every 2 weeks, and at the end of the year, you're going to receive a 1099 that is taxable income to you. What is your responsibility is to keep track of what you've paid. You have to have receipts for those payments, and you have to report that either as a food supply, and I've seen it done as cost of goods, which doesn't make sense, but you can report it as cost of goods if that's what your accountant is doing. But as long as you're reporting that as an expense, you're doing the right thing. Now, excluding the income and excluding the expenses is not permitted. You have to report all the income and then exclude the expenses, which is all the items and all the supplies that you bought with all of the money that you received from the state.
Gotcha. So if I am buying all of my groceries for the food program, then all of the expenses for that, that's not going to be something that I put for my business expenses.
No, you are going to write that off as a business expense. And so all of the food costs that you're purchasing from, so let's just say you go to Sam's Club and you buy it for the week. Those are going to be expenses that are going to go directly on your Schedule C that are going to be a write-off against the income that you receive from the state.
Gotcha. That makes sense. So basically, I put in all of my groceries for the food program. I have all of my reimbursements. Our Schedule C is going to show you how that works out. So if you're using Kid Care, then all of that stuff actually all works together.
All of that should be captured. One is income, what's going to be the expense. It should hopefully net to zero, but sometimes you've overspent. And in rare cases, you might have underspent, but that'll produce either a tax savings or a tax liability, but you have to report both.
If condiments are not reimbursed by the food program, can I still claim them?
If they're used for for the business, if it's a necessary business expense, the answer is always going to be yes. But you have to make sure that you are able to differentiate condiments that are personal versus business. And so there has to be a clear distinction. And if there isn't, that's where the time space would come in as an expense, just like you would with your cleaning supplies, for example. You would be able to use the time space on those expenses. But you have to make sure that these are business expenses if you're looking for 100% business write-offs. If not, time space would be the only way that you would be able to expense them.
So that one kid who will only eat things if there's ketchup on it, that can be expensed.
But you have to make sure that that entire ketchup bottle was used for him,
Just that kid.
just for that kid. If that's the case, then you can write off the entire ketchup bottle. Now, if you're using that ketchup bottle more than the kid is, then I would leave that off entirely because it's more personal than it is business. Now, the IRS, again, in an audit, they're going to do a walkthrough. They're going to essentially look at your business practices. And if they see that you're giving that kid like one little dot of ketchup, but you're using the entire ketchup for yourself, they're not going to allow that as a business write-off.
That's fair. So make sure if you buy the ketchup for that kid, he's using it.
He's using it and you're able to document it and you're able to prove it.